So today's Cardinal Lesson, we're going to just be featuring a long-term care policy that we put a lot of our clients in. And it's a long-term care policy that pays for nursing home, assisted living, home health care, adult daycare, informal care, $10,000 a month. That's $120,000 a year. And it's going to do that for, in our example, the husband and the wife, unlimited. So if you need care for 12 years because you've developed dementia and you live into your 90s, and then your spouse needs care for 5 years or 4 years because they've had a more normal length of time, all of that's going to be paid. There's no limit in terms of time on this policy. So it's pretty awesome. We're going to demonstrate that. And so what I want Tom to do first is to talk about why we're doing this video today.
Yeah, we're doing this video because of everything that we talk about, all the things we plan around. This is the one that would cause a crisis to anybody, even if you're our most wealthy client. This would be a crisis to your family if it happens. If long term care happens, it upends everything. And so you need to have a plan in place of how to take care of that risk, to set your family up where they know what money to use. Because at the end of the day, you're going to get the care you need. It's just who is taking on that burden, is there plans in place? And I think this is a very wise thing and valuable thing that we do with our clients. And so let me bring up the show notes. You can find these below our video. And they're also on our website at cardinalguide.com. We have the board, and then we'll get into the specifics of the actual proposal on the board here, but the full illustration is listed in the show notes. I'll just point out this is a couple who are both 65 here in North Carolina. If you're older, it'll be a little more expensive. If you're younger, it's a little less expensive. Some states are slightly different. So again, depends on where you're at. But this exact proposal is for a married couple, both 65 here in North Carolina. So let me turn it back to Hans. We'll get into the specifics, and if you want to reference back that illustration in the show notes, I think that would be helpful.
Okay, so today's example, Mary is 65 and Joe is 65. They're both married. They're married to each other. And what we've done is we're showing a policy, as we said, 10,000 a month of benefit, and there's no time limit on that for either of them. People like this, and I'm going to compare and contrast it to some things. If one of you or both of you are younger than 65, it's going to cost you less. If one or both of you are over 65, it's going to cost you more. If we go to do this thing all the way to age 80, now you have to health qualify for this. So, and you don't have to be a sprinter or a marathon runner to pass the health test, but if you've got some serious chronic conditions that aren't, you've had an event within a few years, you might have some problems qualifying for this. But we have alternatives if that's the case. And, many times, like if Joe has some real serious heart problems that have developed over the last few years, or he's had an event, and then Mary is in great health, we're typically going to put Mary on this policy, and then we've got an alternative for Joe that he can probably qualify for. So we don't want to get stuck, and we're not recommending this for everybody. We just want to show you how good this coverage can be. Now, I'm going to start off with the first benefit of it, $10,000 a month, $120,000 a year of coverage, and that's the yearly long-term care benefit. And if you want to use this as an indemnity benefit during the first 3 years that you're using it, instead of having to send in receipts for the 10,000, you can just prove that you need it through the triggers of benefits, and you can. So we'll get into how you get this, but they'll just send you a check for $7,500 a month, and you can spend the money as you wish. So you could have a family member taking care of you. You could have a combination of a family member and somebody that you've hired on the outside. They even have training programs for lay people that want to provide care. So they're video training programs that they can get in And this isn't really intended to be a long-term solution, but a lot of people ask us about this, and this particular policy can accommodate that. So that's $90,000 a year during the first 3 years if you qualify for care, but you don't want to be troubled with going into all the rules of the insurance company. You can collect that much for 3 years, providing you continuously qualify. And then after the third year, you're going to have to go to using the normal system, and then you get 10,000 a month on an unlimited basis. So what I want Tom to do is just comment a little bit about just the monthly benefit and the annual benefit on the policy.
Yeah, I mean, I think this is really the amount available that you can spend for care, right? I mean, the cost of long-term care, if you've been through this, you know it's quite expensive. If you haven't, there's sites you can go look at sort of what the average cost is. But the long-term care is really a cash flow problem, right? You have income coming in, especially if you're a couple. The surviving spouse really needs to be able to maintain their standard of living, or hopefully that's what you would want for them. And you still need that income for them to do that, but now you're adding another big expense on top of your already normal living expenses. And you might have the income or the assets, the investments to do that, but we need to start withdrawing it. And so what this does is we set aside some money in the policy now that will provide a future monthly benefit to pay for that care, allowing your investments to stay invested, allowing your spouse, if you're married, to stay there, being able to have their life, and then ultimately it protects some of the legacy for your kids if at the end of the day all this money is going to be passed on to them. So again, it's a hugely important benefit. The 10,000 is the maximum they'll pay. If the cost of care is less, they'll pay it to you a little bit slower. We'll get into why that's impactful later on. But again, this policy is with One America. They've added an indemnity option that's 75% to 7,500 available, which is nice, right? So if you don't want to hire a home healthcare agency, maybe you want to reimburse your kids for taking care of you or reimburse someone in the community. This policy gives you that flexibility, and you don't have to decide that on the front end. You can decide that at the time of needing care. And so, again, it just is a very important number that will help you pay for that care that you're needing in the scenario that you need it.
So I want to add a key point as a financial planner is these benefits are tax exempt. And where this matters, we have a lot of people who have significant assets that just dismiss this subject, say, I don't need it, I got lots of money. If I need care, rather than pay for this insurance, I'll just take it out of my assets. Okay, and I'm just going to tell you that that sounds easy. It gets complicated when you've got somebody who's 85. And first of all, if this is you and you're saying that or thinking this, when you're 85, if you're 65 now, you're not going to have the same capacity to manage money and sell assets and create cash flows that you do now. It's probably going to be your adult children that are going to be helping you with this or acting as the go-between, the financial person. And to create this kind of cash flow, you're going to be incurring some taxes on your investments. Probably your charitable contributions are going to suffer, a lot of things. And I'm going to say that if you have a second home that's worth $1 million or $2 million, my guess is you got insurance on that, and you could probably afford to replace it. But yet you pay for insurance because if something destroyed it, you would want the insurance company to pay for the replacement. That's what this does, is it just indemnifies you, and it does it on a tax exempt basis. Okay, so now let's talk about one of the best features of this plan is it's unlimited. And we really don't have but one other company, and it's a different kind of product that offers still an unlimited. 20 years ago, a lot of the long-term care insurance policies offered unlimited plans. And this is one of the true ones that's still around. So, and why does that matter? Well, first of all, we got a husband and a wife on this policy. And typically, we're going to write this insurance, and it's going to have for the husband and the wife maybe an 8-year benefit or a 10-year. Some are even as small as 4-year. And some people even elect that within this policy to get a shorter benefit period. And let me tell you where that's a problem. So you got a husband and a wife like Mary and Joe. They buy this plan, and let's say they put, an 8-year benefit period because they said, the average is 4 years. If there's two people on it, we got 4 times 2, we got 8 years. And that way, if Mary runs over her 4 years, Joe's still alive, Mary can just use a couple of years of Joe's plan. But the way that really works out is if Mary's getting sick in her 70s, Joe's still in good health, and then she uses it for 4 years, and then she's still around, and maybe she has dementia, she could live a long time. She's using up Joe's benefit so that Joe's going to be at the end of 8 years, he's going to be healthy, and there's no benefits left. That can't happen with this policy. So they don't have one healthy spouse watching the spouse who's in poor health using up the benefits of the other. And with dementia and Alzheimer's, and people are living a lot longer with these diseases, and we're talking about 10-year spans, 15-year spans. I don't know if that many people live now with 15 years, but by the time Mary and Joe get to 85 and 90, that very well could be happening. This insurance indemnifies you, both of you, on an unlimited basis. It could pay out millions. So, Tom?
Yeah, I mean, these unlimited benefits is a great feature of this policy. To Hans's point, is you're not using up, especially on a couple years, you're not using up the other spouse's benefits. I'll just give you a quick story, right? Because we had clients, there were a couple, they bought a policy similar to the one that we're showing here that had unlimited benefits, and the husband got sick, right? He was needing care. We were helping file the claim, and he was over there in the hospital bed, unable to walk, saying, "No, don't start the benefits. I don't want to use up my wife's future potential benefits." And we had to remind him, "No, this is a lifetime policy. The reason you bought it is so you can use it and not have to worry about using up hers." And so it is a real concern when you have a limited amount of money of not spending it for the first spouse when they're needing it, because you don't want to use up the other spouse's future benefits. And so at the end of the day, this unlimited benefits removes some of that or does remove all of that risk, and frees you up to actually spend the money and use the policy that you have. The other thing that I will point out is when we're doing financial planning and when other people are doing financial planning, they never use the average life expectancy to determine how long your money is going to live. Right? We're going to create an income and make sure you don't run out at least to life expectancy. Well, people say, well, what happens if I live past then? Well, you'd be out of money, and then you're on your own. Of course, that's not a great way to go about planning. And so why do we think of averages for long-term care in the same way? Why don't we think of it the same way? I only need it for the average amount of time. Well, averages mean half the people need it more and half the people need it less. Right? That's how you get an average there. And so, don't focus. I mean, it's a helpful number. It gives you some context to think about, but don't make all of your planning decisions based off the averages, because you might be in that scenario where you need it a lot longer, and having the unlimited just solves a lot of those issues. And so, again, that is one of the benefits we really do like about this One America policy. And like Hans mentioned, it's one of the only carriers out there still offering the lifetime benefits.
Yeah. Okay, so let's talk about the benefit triggers. The benefit trigger is pretty simple. You either need, so the first benefit trigger is you need help with 2 of the 6 activities of daily living, referred to as ADLs. So what does that mean? The 6 ADLs are bathing, continence, dressing, eating, toileting, transferring. Okay, so you need human assistance or standby assistance, hands-on assistance with 2 of those 6. And I can tell you from experience, having helped a lot of people through claims, is bathing and dressing are the simplest things to prove with an insurance company, okay? Whether it's this insurance company or anyone else on a long-term care claim, we don't want to fix the people up so they need help with these 2 things, but it's been my experience that by the time people are ready to claim on the policy, they need help with these 2 things. They need help taking a bath. It's dangerous for them to take it alone. And they need help getting dressed. And so if you can prove those two things, especially on home health care claims, or you can get a doctor or a um, medical social worker, there's a number of people that can sign off on this, a care manager that with a professional degree writes down a plan of care and that you need help with those two things, that's going to turn on the benefit of the policy. Now, that's not to discount a lot of people that are filing a claim or they're in a facility, they need help with eating, they need help with toileting, they need help with transferring. So go ahead and put them all down, but I'm just talking about where the line is. Bathing and dressing are the simplest, the clearest, and that's when I help people submit claims, that's all that's on the form and all on the doctor's statement. Um, so this is an or thing. So you either meet the 2 of 6 ADLs or you have severe cognitive impairment. So there's many people with severe cognitive impairment at some level can do all 6 of these ADLs. But and where I find is so we're going to prove the cognitive impairment. We're going to get the doctor that people that are cognitively severe cognitive impairment, they've got a diagnosis. It's pretty simple to have the doctor just document that and send it in with the claim. But then when there's people that aren't quite there yet, but they're headed that way, or they're into the diagnosis, and it gets into these. But they need care. What they need care with is they need help bathing and they need help dressing. So sometimes it's just easier to put down both. Is just to put down the cognitive impairment and have the doctor certify that, and then meet the 2 of 6 ADLs. So I'm just going over this because this is the same in this policy and every other long-term care policy that we sell. And people bring this up when they've done their research. It's like, what are the benefit triggers? How, is the insurance company going to keep telling me, no, 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 you're not quite there yet, or papering us to death? Here's what I'm going to tell you is that there's such a thing in the tax law called a tax qualified long-term care policy. It's written, we've done other videos on this, and perhaps we'll bring it up again. We put the tax code up, and the tax code itself writes this language into it to make it a tax qualified long-term care policy. So the insurance companies, when they write these policies, they've just got that tax code transferred into the policy. Tom?
Yeah, I mean, I think like Hans mentioned, this is the same across all the policies, right? This is standard. It's in the IRS tax code that really drives these provisions. So this is not unique to this company. They all treat this the same way. And this is the area on the back end of the policies where we see a lot of mistakes, right? Where people are trying to file a claim. They don't know what the triggers are. They're just putting stuff down and they write, a 2-page book over what's going on with mom or dad, but it never specifically addresses any of the activities of daily living, and the claim gets denied. Right now, you can appeal it. It's not like a forever denial, and oftentimes we're helping people refile it, and eventually it gets approved. But that's frustrating, right? That's happening right at the time that mom or dad is sick, they're needing care, you're trying to figure out how to pay for it, and you get this denial from the insurance company. And so before you file the claim, make sure that you know what triggers need to be addressed on that claim form, and that can help smooth out that process of when you file the claim. We help a lot of clients with that on the back end, policies we sold and policies we didn't, right? Because there's mistakes that get made. It's frustrating. It's hard. If you've never looked at this, you don't know any of these things. So make sure you understand that, or your family understands that on the back end. And again, that's something we help with. But like Hans mentioned, the two easiest to prove and the ones that we use most often are bathing and dressing, because it's pretty clear cut. You either need help or you don't. You start getting into some of the other ones, they're a little bit subjective, and again, you don't want to leave anything up to chance with these companies, right? You don't want to give them a reason to say no. Let's really make a very clean claim, make sure it addresses these things directly, and it should go through no problem. But again, that's a little bit of guidance of how to handle sort of the back end of these policies.
So now we're going to talk about an elimination period. And an elimination period means it's like a deductible. And so typically, long-term care policies, a lot of them have 90-day elimination periods. And this one does as well if you go straight into an institution or into a facility. So if you've got this insurance and you have a cognitive impairment you don't get any care at home, you just go straight to the facility, well, then the first 90 days are not going to be covered. That's like a deductible. But if you start getting your care at home, so you've got like a partner or a companion care where somebody starts coming in and running around with you all day or sitting with you at home, helping you with some of this stuff, you've got dementia, and your spouse is then able to go on and have a life 5 days a week. And so you've got somebody coming over 8 hours a day, 5 days a week, for instance, or maybe 7 days a week. And they're doing companion plus home health aid services. You're going to have no elimination period. So you're going to just going to start from day one. They're going to be paying the 10,000 a month or the 7,500 a month if you're not going through an agency. You're just hiring people straight up. Now, the thing about that is those 90 days are like, typically people don't do that for a month or two and then go to a facility. I mean, a lot of times that's going to go on for a year or two, or 6 months or 18 months or something. And those days count. So then when you then go to the facility, you don't have to incur the 90 days again. So if they've paid 90 days at home, you're going to have no elimination period for anything. Tom?
Yeah, I mean, I think that's an important point is that the days at home, which have no elimination period, count towards those 90 days if you do have to go to a facility. Furthermore, if you go to the hospital and then have to go directly into like a rehab or nursing home or something like that, there is no home health care. There's that 90-day elimination period where you're having to pay the cost. Medicare will pay for some of those days, probably not the full 90 days, right? They're going to stop paying probably before you hit the 90 days, but some of that might be covered by Medicare. Now, again, very situational specific, not a guarantee. It really just matters what the details are of what's causing the need for care. But there is a chance Medicare could pay for some of it. But at the end of the day, it's just a way that the insurance company, they can charge a little bit less for the policy, knowing that they have you have some skin in the game, like a deductible on a health insurance policy there. And so with this particular company and most of these hybrid policies, that's not something that's adjustable, right? It just is what it is. You can't change it. So that's just something to be aware of.
Okay. So this is also a life insurance policy, or I guess it's first a life insurance policy. This is a hybrid life long-term care policy. So you're buying a life insurance policy. The life insurance policy is $240,000. So that's how much money is going to be paid to your beneficiaries when the second one of Mary and Joe passes away. So Joe makes it to 80, Mary makes it to 90. After Mary's death or the second death, the $240,000 is going to go to the beneficiaries, unless they've used it for long-term care. So, because it's a hybrid life long-term care policy. So it's a pretty safe assumption that either Joe or Mary or the combination of the two is going to use 2 years of care. So they're going to collect $240,000 out of this policy. And when they do, there is going to be no life insurance. Once you've collected that much in long-term care benefits, there's no life insurance that goes to the beneficiaries. So you say, well, what good is it? Well, it's a lot of good because the whole tax character of this thing is set up in such a way that it has to be life insurance. And it's also good if both of them were killed in an accident or something at 75, or both of them just live a long life and they don't ever use the care, then just about their whole premium that they paid to begin with, if they paid a single premium, is going to go to their heirs. So it's a return of premium benefit, if you could look at that way, for not using the insurance. Tom?
Yeah, I mean, the life insurance, that's not the primary reason that you're purchasing this policy, even though that's sort of the base part of the policy. The benefits there are not really designed to be that great, but it is nice that if you never need care, because one of the complaints about traditional long term care policies, which is what most people are familiar with when you bring up long term care, is if you never need care, which is the goal, right? I hope no one ever needs care. Now, realistically, we know that's not true. A large percentage of people will need it. But if you don't, if you are of the lucky few that don't need the care, then that money's coming back to the estate. Now, it's not that much more than you put into it, but it's money that's not just been spent, that's gone. And so I think it's a nice feature. It's a nice sort of way to, again, know that someone's going to get some benefit from the policy. Again, not the primary focus of why we're recommending it. But again, if you don't need care, and then furthermore, say you need a little bit of care. So in this particular policy, the death benefit's $240,000. Let's say you use, I don't know, $100,000 of care between the two of you, but both between, husband and wife. Well, you would take the 240, subtract the 100 that was spent for care, there would be 140,000 left as a death benefit. So someone is going to get 240,000 out of this policy one way or another. Now, if you needed care for a much longer period of time, you could get a lot more than that out of the policy. But again, that's why you're purchasing it, is for that protection of the lengthier stays of care. So again, it's a nice thing that's on there, not the primary reason you're buying it, but it is a way to reimburse, essentially be the estate, because in this scenario, both of you would be gone. But that money is coming back to your beneficiaries, whether that's your kids, nieces and nephews, charity, whoever it is, they're going to get that money if you don't need it for care.
Okay. Now let's talk about the money. So if you bought this with a single premium, $243,929. A pretty large downstroke, but that's, if you've got that kind of money, it needs to not come out of an IRA. It needs to be just in a CD or in a brokerage account, money that you have that you've already paid taxes on. You could pay one time and be done with it. Okay. Now, this particular company has an alternative to actually use an IRA. So you could purchase this identical policy by transferring $272,678 of IRA money over to One America, and they're going to put it in an IRA account, and they're going to pull out of it $34,000 a year, essentially, for 10 years. And, that adds up to more than that. It has an interest factor. We have other videos on tax qualified or using your IRA to buy long-term care insurance. And we're just starting here. But I'm just showing you, this is the premium if you pay for it all at once with after-tax money. If you want to buy this same policy using your IRA, it'll be one-time transfer of $272,000. And you won't incur the taxes on the whole $272,000 right away. That's going to be spread. The tax liability is going to be spread over 10 years. So it's piece by piece. It'll even count as your minimum distribution when you get to be 73. If Joe or Mary would buy it out of their IRA. So I don't want to get too much into that. The single premium, $243,000. You can do a 5-pay, which you're not doing a big chunk all at once, but it's pretty significant, $64,000 for 5 years. You can do a 10-pay, which is $34,000 for 10 years. And you can do a 20-pay, which is $21,792 for 10 years. So I'm just showing you this as a staple, and I made the benefit $10,000 a month. And what I was going to explain to people is, if you're looking at that, say, I'm not going to pay that kind of money, and there's a midpoint, is you could buy half of this plan for half the money. I mean, this transfers in a linear fashion. So I really don't expect people to call up and say, yeah, I want that plan for that much money. How much is it? I'm just showing this as an example, and we're somewhere in the ballpark. Now, what I'm going to add here is sometimes we send in applications on Joe and Mary, and Joe gets turned down, Mary's approved. Okay. So then Mary is not going to get this same policy. What she's going to get is a policy. We could set up these same benefits, but it's going to be different because it's going to be a first to die life insurance, and it's going to be a larger benefit. And Mary, because she's a lady, she's female, she's going to pay about 65% of the premium for the same benefit, 65 to 70%. I'm just as a generalization. If it was reverse, if Mary was turned down and Joe wanted to buy the policy, then Joe would pay about half this premium for a single policy with a larger first to die benefit. That gives you some general areas. And you could discount that if you wanted to buy a less size policy, a smaller policy. So there's a lot of flexibility, and that's what we're here for, is if you wanted to take a look at this, or even some of the other hybrid companies with different companies, that's what we do for a living. You just give us a call or send us an email or a message on the website. We'll be glad to talk to you. Tom?
Yeah, I mean, I think like Hans mentioned, this is just an example. This is not a recommendation for you specifically. And oftentimes we're doing these as part of a larger financial plan, right? Because we need to make sure that you have enough other money to be able to support your income needs, all the other goals that you have, take care of this risk, right? So it's built as part of a larger plan. We would never recommend something that we thought you couldn't afford, right? If you're going to have to sacrifice your lifestyle for something like this, we might reduce the benefits some, or look at something else to do that with. So again, with all of the things we talk on our videos, needs to be part of a larger plan. It's not just a blanket recommendation for everybody. But we did want to just give you an idea of what the cost looks like for a policy like this. And like Hans mentioned, it's pretty linear, right? So you cut the premium in half, you get half the benefits. You double the premium, you get double the benefits, right? And you can sort of do the math on that. And 10,000 is a pretty easy number to play around with in doing so. So uh, again, if you have questions or this is interest to you, or you've been through some experience with your family for long-term care, you don't want to go through, you don't want your kids to go through that or your family members to go through that, call us, help us. We can look down, we can look at a larger plan, make sure something like this would make sense, and help you get something to protect you and really to protect your family from having to go through this.
Most of the people that buy long-term care insurance from us and through us, it's a result of a recommendation when we're doing a plan on everything. And so, we're going to plan out their Social Security, claim it, show it in the financial plan whenever it starts, the spouse's amount for the rest of their life. Um, we haven't talked about Medicare, but I mean, Medicare, the whole reason we need long-term care insurance, it doesn't do much for long-term care. The whole video has been about long-term care. We did mention the IRA option, which it doesn't have to be this amount, but we can take an amount in an IRA and purchase out of one IRA and purchase a policy for both people, both spouses. Um, we're usually creating an income for the people, and people's income is going to come first before they're buying long-term care insurance. But it's also, I'll mention that long-term care is a threat to your income because it's going to all go toward long-term care if this happens to you. Estate planning, we talked a little bit about that. This is smart estate planning where you're not spending down the estate to pay for long-term care in the end. And then we've talked a little bit about taxes. We try to, in all our financial plans, we're trying to be tax efficient. And certainly buying long-term care insurance is tax efficient because on the back end, these benefits are going to come on a tax exempt basis. So I want to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.